Hello and welcome to interest.co.nz. I'm Jason Bowles and I'm here with Minister of Finance Grant Robertson. I'm just going to jump straight into a few questions here. Let's start with the economics of well-being. I'm interested to know what that means for the average New Zealander.
Well, I think what it means is that they can have some assurance that the government is thinking about their overall well-being. And when we're doing budgets, we tend to do a pretty good job of assessing economic activity using GDP, related indicators, things around employment, unemployment. What we haven't done a good enough job of, in my opinion, in the past is saying, how does that then influence overall well-being? What do we know about people's environment that they live in, the community that they're in, the strength of that, how safe, how secure is it? What do we know about the quality of the air they breathe, the water that they swim in? How are we making decisions and trade-offs about their individual skills versus the overall health of the economy? So it's about making sure that when we're assessing what we invest in and how we measure the success of that it focuses on someone's overall well-being rather than just narrow economic measures. This hasn't been done before in terms of a budget, and so it means that we're working through the process of what indicators would be able to show those things. But the goal for budget 2019 is that we'll be able to show both why we've chosen to prioritise things and what measures of success we've got on a much broader basis.
And you mentioned there that New Zealand would be the first country in the world to do this. Isn't there a little bit of a concern that we might be out of step with the rest of the world that still measures GDP as the measure of a country's success?
We'll still be measuring GDP because it is important that we understand the level of activity in our economy and that we've got consistent long-run measures that we can make some comparison with. What we're going to be doing is adding to that and be able to make better decisions, in my opinion, about the various trade-offs that you always have to make when you're putting a budget together about what gets prioritised at what given time. I think it's really important and exciting work. New Zealand in the past has not been scared of being a world leader, and we shouldn't be again here.
Let's move on to the Reserve Bank. And in the past, the IMF has pointed out that the central bank has a light-handed approach when it comes to regulation. And I'm just wanting to get from your perspective how comfortable you are with the Reserve Bank's approach to regulation.
Well, that's the subject of, in part, of phase 2 of the review that we're doing. And obviously I'm aware of what's been said. Clearly it has been a light touch model, and the Reserve Bank itself acknowledges that's what it does. There are alternative views as to that. That's what we've got to explore through the review process.
Because there's the CBL example as well, and we're looking at the second part of the review process. So at this stage, do you have any indication of any changes that might be afoot on that?
No, because we need to do the review properly. But I think everybody recognises that in our Reserve Bank, we have a body that obviously deals with core monetary policy, but it has roles around regulation and financial stability that in other jurisdictions like Australia are separated out. That means that we've got to look at the bank and make sure that it's fit for purpose to do the job, and that the rules and regulations are the ones that suit our economy. But I'm not going to prejudge that. That's the very reason why we want to do the review. We all understand what's been said by the IMF and others as the process goes through, and those ideas will be tested as part of phase 2.
Now, just on the first phase of the Reserve Bank changes, you mentioned things like full employment. And in the past, the government is looking to get unemployment to below 4%. Jacinda Ardern said in the past, but the Reserve Bank would look at something like 4% and potentially say that that's kind of slightly overcooking of the economy and might respond essentially by hiking rates. So I'm just wondering, how should New Zealanders and market watchers interpret full employment?
Yeah, so full employment is a debatable topic, and we all understand that. You'll see when we phase 1 of the review gets announced and we have the policy targets agreement, the way in which we'll express those ideas. What I've said from the beginning is we would not tie the bank to a specific rate of unemployment. I understand the limits of monetary policy, and so we want them to be considering maximising employment. but unlike an inflation, particular inflation target, we wouldn't be seeking a particular employment target through monetary policy. The government, on the other hand, can set targets because there are a lot of other policy levers that will be pulling to try and drive down that rate of unemployment. Equally, there are issues around underemployment, underutilisation. Those are all policy issues that we can work on. What we want is the bank to play its appropriate role in maximising employment. That will not include a specific employment target.
And so the government's target's still roughly 4%?
We've said 4% in the first term, and the projections that Treasury gave us at the half-yearly update is that would happen. We're going to still have to continue to work hard to make sure it does. But also, as I mentioned, the unemployment rate is one measure of how we're going in terms of the labour market. I think I'm keeping a close eye on so-called underemployment, underutilisation. When you've got, up to, in previous surveys, 300,000 people saying, I'd like more hours, that's actually something we've got to look closely at. We're creating jobs, but are they the jobs that are providing people with sufficient hours and income to be able to live the lives they want to live? So we'll keep looking at other measures as we go along, but the 4% goal is the one we've set for the first term.
Is it not a worry that this getting below 4% and the government's moves to increase the minimum wage is going to put a rocket under inflation, and that's going to go further up?
The forecast is not for that to happen. So the forecast is for inflation to sit near to 2%, which is obviously the midpoint goal for the bank. So at the moment, that's not what's being projected. And obviously around the world, people are keeping an eye on the fact that there might be some growth in inflation, but in New Zealand, it's forecast to be modest.
And just on that 2% target, I mean, we've got the policy target agreements coming up soon. Any indication if there's going to be any changes on that?
Look, I've said from the beginning that there wouldn't be a significant change there, that we would keep the band, broadly speaking. You'll see when we come to the finalisation of the PTA what that will look like, but the indication I gave as far back as last year is that we would maintain the broad inflation target that's been in existence.
Now, something else that you indicated when you were the finance spokesman for Labour when you were in opposition, was around debt to income, and the Labour Party was never really keen on that. Grant Spencer has come out recently and made comments around how he thinks that debt to income servicing ratios should be in the Reserve Bank's toolkit. What do you think?
Well, that's consistent. That's a consistent view that he's held. We'll take a look at all of the macroprudential tools as part of the Phase 2 review. They were already due to be reviewed anyway, and the process for creating them. So that will be what happens in Phase 2. My personal view hasn't changed. I've got concerns about the impact of debt to income ratios on first home buyers. That remains my personal view, but let's see what the review comes up with. And
just on the housing market, I mean, it seems if we look back even 12 months ago, things have really calmed down, especially in Auckland. What is your government and your specific office's perception of the housing market in New Zealand right now?
Yeah, look, we certainly saw the cooling, for want of a better word, in Auckland. Although again, just in the last couple of months, a little bit of a pickup again. So you've always got to keep your eye on that. We've always said that we think moderate, sustained house price growth is likely for a period of time rather than the big spike that we've seen. But equally, look around the rest of the country. You have seen some big increases in places like Wellington. So I wouldn't say that we're by any means, mission accomplished on housing. We're still way behind in terms of supply. We're still up to 60,000 houses short. We've still got issues around speculation. And so, we can have waves of this, but the fundamental issues that lie behind what drove the housing crisis actually is still there, and that's why the government is so focused on those issues.
What does mission accomplished look like?
Yeah, well, mission accomplished would look like having a significant increase in the supply of housing, especially affordable housing. It would be making sure that home ownership rates are improving. It would be making sure that we get rid of homelessness. It would be improving the rental stock and the quality of that rental stock. Minister Twyford could give you a very long interview about that, but there are a lot of issues to resolve there. We'll keep an eye on where the market is at a particular moment, but I think what we saw in the housing crisis was a set of underlying issues, which is what we're focused on resolving.
Changing tack a little bit, let's talk about deposit insurance. Does your government want to introduce deposit insurance or a banking inquiry as proposed by Mr. Peters before the election?
Yeah, look, those things didn't end up in our coalition agreement or in our confidence and supply agreements. At the moment, we don't have work particularly underway on those areas. Obviously, the individual parties will continue to hold their views, but that's not part of the agreements that we signed.
So it's not anything part of what you're doing in the future. You may look at it or you may not.
It's certainly not on my current work plan. No.
Right. Shamabil Yaqub said a couple of weeks ago to get debt down to 20% by 2022, he called it a fiscal straitjacket, and there's been some comments on that in the past. But I'm wondering, debt is quite cheap now. Why would you bother even getting debt down to below 20%?
Oh, I think we've all learned the lessons of that from the global financial crisis. New Zealand's a small economy, advanced economy, but we are prone to external shocks, and indeed, as we've seen in recent years, to internal ones in terms of earthquakes. So we need, as a small country, to be very prudent with our debt levels. I don't regard the target that we have as a straitjacket. We have a slower debt reduction path than the previous government did because we've got investments that we want to make. While the economy is continuing to grow, we'll have additional resources to spend on the important things that we want, but we have to balance that against being fiscally responsible. And I think we owe it to the electorate. We campaigned on those budget responsibility rules. We've agreed them, they're part of the budget process. We need to stick with that and keep faith with those. We've always said in terms of those budget responsibility rules, if there was a major external shock, clearly that would have an impact on them, but they remain our goals and targets.
Well, a lot of when it comes down to Crown debt it's about the rating agencies looking at New Zealand as a good credit risk. New Zealand has some of the lowest, if not the lowest, debt levels in the OECD. So what is the difference between just a couple of percent? I mean, surely they'd still look at New Zealand as a good credit risk if we did have an external shock, if we were at 23, 24%.
Sure, but we're setting ourselves a goal and a target, and I think it's important to have that discipline. We were very well served in the global financial crisis by the fact that we'd kept our debt levels low. So, of course, 1-2% here, you might argue, doesn't make that big a difference, but the track and the target and the goal are important to those rating agencies to be able to see that we have a plan and that it's a balance between meeting the important social and infrastructure needs of the country and managing our finances responsibly. That is the goal and the plan we have. I don't share Shamabil's view that it's a straitjacket. I think we can do really good, positive things for New Zealand within those budget responsibility rules.
And is there an upper limit to that? Say, for example, if there was an external shock, what would be the upper limit of what your government would be could be borrowing?
I don't think you can make a judgment about that right now. I mean, what we saw in the global financial crisis was that debt ratios went much higher than where we are now. But I don't want to put a number and a figure on that. It's really just the acknowledgement that we made when we announced the budget responsibility rules that from time to time things are going to happen in the economy that mean that you have to take another look. I'm not forecasting that at the moment. I'm not forecasting another global financial crisis, and I'm certainly not forecasting another earthquake, but we just have to acknowledge that that's a possibility one day.
And New Zealand, by a lot of people's standards, is at what they call the end of the business cycle. We saw basically some things like these go in 10-year periods. A lot of people are getting a little bit nervous that we're coming through the end of the cycle. What is your view on the economy, and do you think that we're maybe in a position where we can sail through this onto the next one?
Yeah, look, I mean, I think you've got to look at that firstly in the global context. And so the global context is that growth rates are forecast to be pretty good, to be honest, over and above 3%, 3.5% in the global economy. So there's strength there that we as a relatively small country need to be aware of. It's not to say that it's without risk. Many of those are geopolitical risks actually at the moment as opposed to particular economic risks. But they exist, and we've got to be aware of those. We've got to be aware that what we saw with some of the changes in equity markets and so on and different asset classes can lead to instability. So we've got to be aware of those, but broadly speaking, the global economic outlook's good. So that gives me some confidence that New Zealand as a trading nation can work through those. In terms of the New Zealand economy, the forecasts I'm seeing are still sound. We're still talking about nearly 3% on average growth. We are forecasting unemployment to go down, wage increases to be around 3%. So I think there's an underlying health in the New Zealand economy that makes me confident that we can work through the next stage in the economic cycle.
Sounds like a good place to leave it. Thank you very much for taking the time, and thank you very much for watching.